Hey friends, welcome back to the Quiet Learner channel. Today, we are breaking down investing in stocks and shares. Drum roll! What it is, why it matters, the risks, and how to get started intelligently. You know this is a book-driven channel. I'll anchor some ideas in books that I've read, from The Psychology of Money to Atomic Habits and much more. So let's jump in. In the first section, we will be talking about what stocks and shares are. What are they? What are stocks and shares? First of all, a stock is simply a piece of ownership in a company. When you buy a share, you are simply buying a fractional piece of that business. Its profits, losses, and future potential as well. Think about it like the richest man in Babylon. Your money becomes your slave, going out to work for you. Now, stocks are one of the most common ways people put their money to work. Even when you are not there, it's making money for you. You are not just buying a ticker symbol. You are buying a real functional business. Section 2. Why invest at all? Why bother? Why invest? Why not just save? This is because inflation eats into your money over time. Most times, the interest in your savings account might merely track the inflation rate, but it hardly beats it, right? So when you leave your money saved, it is actually losing value. So you make your money work harder for you by investing. Investing allows your money to grow faster than inflation through dividends, share price appreciation, and compounding. If you are frequent to this channel, you would know by now that one of the words I use so frequently is compounding. I love compounding. Compounding is that magic to your wealth. Morgan Housel, in The Psychology of Money, explains it best. Wealth is built quietly, slowly, through the power of compounding and consistency, not sudden jackpots. So, investing is not about timing the market. It's about time in the market. Not timing it, but time spent in the market. Duration. Trading is about timing the market. Investing is about patience, compounding. Section 3. Risks you must understand. Before we go any further, let's talk risk. Because balanced investing means knowing the downside. Yes, the stock price can go up. At the same time, it can come down. I think it's Warren Buffett who always says, the stock market takes the stairs up and the elevator down. So when it's coming down, it's crashing, boom. But when it's climbing up, it usually takes the step up. It's slow, the stairs. It's just kind of like slow. But when it's crashing, brrr, so you need to understand the risks. A good investor is good at taking calculated risks depending on your risk tolerance. Some are high risk, high reward investors. Others are low risk, low reward investors. Some have moderate risk appetite. But risk management is really crucial in investing and trading as well. Number 1, there is the market risk. Prices go up and down. It's normal. Swings up, swings down. Volatility is normal. Volatility simply means the ability of something to change quickly without any notice. It can go up, it can go down. Unpredictability, it can evaporate, just like you say, water is volatile. It can just evaporate into vapor. Volatility. So the market can go up and down. It doesn't need your permission to do that. So market risk is number 1. Number 2 is business risk. Companies can fail, even the big ones. Think back as to when smartphones came out. Who were the front runners? The ability of those companies to remain competitive as technologies get disrupted, as the markets evolve, as AI is coming, is disrupting. How are those companies aligning, remaining resilient, future-proofing their business model, future-proofing themselves, their revenue? What's their recurrent revenue? What's their annual revenue? What's their, how are they partnering? How are they securing those contracts? Who are their customers? Okay. In business strategy, we have Porter's 5 forces. The threat of new entrants. Who are those that are entering the market newly? Are they going to disrupt the market? Okay. What's their barrier to entry? How are they going to scale? How can they compete with this stock or this company you are invested in? So threat of new entrants. Threat of substitute products. We also have the bargaining power of the buyers. Who are their customers? Who are buying? How are they pleasing them? What's the customer retention? Who are their key consumers? Then we have bargaining power of suppliers. For instance, Nvidia supplies to Tesla, supplies to things like maybe Supermicro Computer, Broadcom, or AMD, Intel. Who are their suppliers? Who are their buyers? How are they remaining relevant and dominating as category kings or market kings? Also, for instance, in the EV market landscape, who is Tesla's competitor? Let's say BYD. What's Tesla's market share every year? Is it dropping per quarter, per month? These are the things to keep tracking in order to manage risks properly. It's not advisable to just leave your portfolio that way and just go and sleep. Keep researching, keep making sure that you are invested, you are positioned for the best. And then the final one is rivalry among existing competitors. This is what I was saying, for instance. So just to recap Porter's 5 forces, we have threat of new entrants, threat of substitute products, bargaining power of buyers, bargaining power of suppliers, and rivalry among existing competitors, okay? So for instance, Tesla, their market share in EV was quite high until BYD came in and started disrupting the market. They came with a lower price entry point, they've captured the Chinese market share and they are gradually eating into Europe because they are quite affordable. So people who buy Tesla are buying it probably for different things. But the point is this, there will be new entrants, there will be substitute products, even among the people who are already there. How are they eating into the market share? One of the books I'll recommend for this is 22 Immutable Laws of Marketing. Here you have, different strategies to know how companies are doing well to remain competitive. So first, market risk, business risk, and then emotional risk. Your reactions can hurt you even more than the market. In the book, The Chimp Paradox, Professor Steve Peters explains how our inner chimp reacts emotionally. Your investing chimp wants you to panic sell when prices drop. Don't let emotions drive your decisions. We also have geographic risk. If all your investments are in one country, you are exposed massively to that country's economy, politics, currency, and regulations. People make this mistake a lot. They get sucked into the US stock market and they forget about diversifying into Europe, diversifying into Africa, diversifying into Asia, Australia, Canada. There are so many other markets, emerging worlds. There is the African stock market. In Africa, we have things like MTN, Airtel, Dangote, BUA, so many things you can buy. Nigerian banks, come to the UK. There are so many companies you can invest in. It's not advisable to just get sucked into the US because that's what you're hearing in the news. That's the hype. Always diversify geographically and by sector. The fifth risk, concentration risk. Putting all your money in one company or one sector is dangerous. So in the 22 Immutable Laws of Marketing, we are reminded that market shifts. What is hot today may be gone tomorrow. Understanding risk is the first step towards managing it. A recap of all the risks: market risk, business risk, emotional risk, geographic risk, and concentration risk. Section 4. How do you now reduce this risk? How to reduce risk? It's simple. Diversification. Diversification simply means spreading your investments. You know this saying, do not put all your eggs in one basket. That is diversification, simply put. Ways to diversify across companies, across sectors. So you have technology, energy, nuclear, rare earth metals, you have AI sectors, you have automotive, you have EVs, precious metals like gold, silver, even cocoa, commodities, oil, diversify, banking sector, fintech, real estate, commercial. There are different ways and different places to diversify. When you've diversified across companies, across sectors, also across countries, US, Europe, emerging markets, and all, and across asset classes, stocks, bonds, real estate, cash, exchange traded funds or exchange traded commodities. For me, I'll go on to say crypto. In the UK, premium bonds. For those who don't want to buy physical real estate, you can do REITs, REITs. So in that way, you're investing in real estate companies. Okay? So think of diversification as applying James Clear's atomic habits. Small, consistent decisions, spreading risks, leads to huge long-term gains. The goal is not to eliminate risks. This is impossible to do. It's to avoid being wiped out by one bad decision. Got it? Section 5, active versus passive investing. So there are two main approaches. Active investing, here you are picking individual stocks. It has a higher potential to return you much more money. That's good. But also, the risk is higher because you are picking out just one stock. However, in passive investing, you buy index funds or exchange-traded funds. These funds track the market. They have lower costs and historically strong returns. However, be mindful of their expense ratios. Some of them have very high expense ratios. For instance, ETFs that track specific sectors like maybe semiconductor sector or crypto, digital assets, those ETFs can have a high expense ratio of up to 1%. So be mindful of this when you are investing in ETFs. Currently, the S&P 500 ETF, VUSA or VUAG, the Vanguard S&P 500, I think the expense ratio currently is 0.07%, and this is a good one. If you are new, passive investing is one of the simplest ways to begin, and it aligns with the lessons from the 7 habits of highly effective people. Habit 1, be proactive. Set a simple system and let it run. Section 6, practical steps to start investing. So here is a simple beginner-friendly path. 1, decide your goals. Short-term or long-term. Retirement or wealth building. 2, build your emergency fund first. This is 3 to 6 months of expenses. If, for instance, something were to happen and you lost a job or anything, your emergency pot should cover 3 to 6 months of expenses. Do this first before you start investing. This helps you not to invest money that you would need in the near term. Number 3, choose a platform or brokerage and make sure it is regulated, it has low fees or no fees at all, and easy to use. Okay? In the UK, make sure it has FSCS protection. And platforms like, there are lots of them. We have Robinhood, we have AJ Bell, we have eToro, we have Hargreaves and Lansdowne, we have Trading 212, we have Fidelity, we have Vanguard. For things like crypto, we have Coinbase as well, and eToro, and Robinhood as well for crypto. In Nigeria, we have Chaka, we have Bamboo, and we have others. And these platforms in Nigeria give you exposure and access to buy stocks all over the world, in US, in UK, everywhere. If you are in Nigeria, look out for Bamboo and Chaka, and their rates are quite low. And even if you're in school or in university, don't wait until you come out and you start investing. Right from university, you can start throwing your 5k instead of using it for things urgent 2k, throw it into stocks, okay? Buy fractional shares. Fractional shares means you don't have to wait till you can afford, let's say, $1,000 for Eli Lilly stocks. You can just buy a fraction of those shares, 0.1%, 0.001. Just start small, okay? The idea is to be consistent. So we've said decide your goals, whether long-term or short-term. 2, build your emergency funds first. 3, choose a platform or brokerage. Number 4, start small And automate. Automatic monthly investments remove emotions, okay? Atomic Habits again says systems always beats motivation. Systems is greater than motivation. Number 5, diversify early enough. Don't bet everything on one stock. Please, please, please diversify. Number 6, think long term. Warren Buffett says the best holding period is forever. Don't sell and start crying later. Hold it, hold it, hold it. As long as it's still doing well, as long as you've done your analysis, this stock is well positioned, please, 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 please don't sell. Okay? Keep holding. So, investing isn't about predicting the future. This is one thing I like about the book, Same as Ever by Morgan Housel. It's not about predicting the future. It's about preparing for it sensibly, patiently, and consistently. So, if you take anything from this video, let it be this: start early, stay calm, diversify, and keep learning. I hope this introduction helped. So if you want deeper videos on creating a portfolio, ETFs, or analyzing companies, let me know in the comments. And of course, stay curious, stay learning, and see you in my next video. See you. Bye-bye.